And dare I ask, what are you looking at in the cockpit right now, and in terms of the recession risk?
Um, sure. Well, one of the concepts in macro that I think is hard to grasp sometimes is that there's a huge lag between monetary policy and its eventual impact in the economy. It's about 2 years. And so the economy is usually at its most vulnerable 2 years after the end of Fed tightening. And if you throw some sort of shock at that time, well, you're going to push the economy into recession. And I would say tariffs are an inflation shock. They're kind of a grenade for our economy right now. And so the odds of having a recession just went up dramatically. And so that's a perfect example of, how the business cycle works. I think because of special circumstances, we would have been able to avoid a recession this time around. Tariffs obviously increase the odds significantly that we're either in one or about to enter one.
Mhm. Fascinating. So I see all the quotes. I think JP Morgan thinks yes, we're heading for a recession. I think IMF I saw yesterday thinks no. So why do people disagree on these sorts of things?
Well, at the end of the day, these are what I would call unconventional tools or tools that nobody really has a lot of familiarity with.
Hmm.
Economists of my generation, we're not trained in tariffs.
Hmm.
We're trained to believe in free trade. And
Hmm.
so I think a lot of us are trying to educate ourselves as quickly as we can. But the conclusion is pretty clear: leads to higher inflation, leads to slower activity. And we're seeing that pattern in a lot of leading indicators. And so, for
Hmm.
instance, when we bring up the ISM index we were looking at, it has plunged in the last few months. But the inflation proxy in the ISM, it's a series called prices paid, has been ticking higher. So we're entering this stagflationary dynamic in the data that is rarely seen. And so that's bound to lead to a huge debate. But I would say leading indicators are telling you that we're in for a pretty rough ride here.
Hmm. So let's say you're correct and the IMF is incorrect, and we're going into a recession. By the way, you're in very good company in predicting a recession at this point. Clearly, I've seen lots of estimates in the last few weeks agreeing with that and talking about that. Um, so um, so say you're correct. What's the benefit of being correct on that call?
Well, the markets, I would say, are more binary than they used to be. And what I mean by that is that whether you're looking at the relative performance of a sector or the alpha generated by a factor, they either work when we're in risk on mode, so when economic prospects and leading indicators are improving, or vice versa, they're going to generate alpha when the economy is slowing, when leading indicators are losing steam. So having the correct call on the direction and prospects is huge because it will increase your odds of finding stocks that will actually generate alpha in your portfolio. So this is a big deal. In this case, I would say my conclusion pushes me toward, what I would refer to as a risk aversion portfolio. So lower beta stocks with lower valuations. You
Mhm.
always have to put things in context. And this time the context is inflation. So it's important to think about companies that have pricing power, that can weather some of this stuff. But all that stems, at the heart of it from macro trends.
Gotcha. Okay. Very good. So you can basically generate alpha against your benchmark.
Well, I would say understanding macro increases, the odds that you will
Mhm.
be able to do that. Yes.
Yeah. And you have to be correct as well.
Well, that helps. Yeah.
Okay, so tell us, there are a lot of economic indicators in this PSM. So let's play desert island discs. If you could take one economic indicator on a desert island forever, which would it be and why?
Yeah, well, you've already put it up on the screen, Rob. So about 30 years ago, I discovered this little known data point. It was called the NAPM Manufacturing Index back in the day. And I discovered it because Fed chair back then, Alan Greenspan, used to refer to it. That has since become the ISM index. And so it's a great leading indicator of the economy. It's timely, it's released on the first day of each month. I would say 30 years later, there's a lot of other similar data points because virtually every regional Fed in the US now has its own, PMI, Purchasing Managing Index. So to me, those are really helpful. So if I have to pinpoint to one thing, that's probably the one series that I look forward to the most each month, and that I think is the most helpful at the end of the day.
And what's it telling you right now?
Well, it's telling you that the economy is in for, a significant and sudden slowdown because it has collapsed in recent months. The ISM index is the series that everybody looks at, but it has subcomponents that, really tell you the story. And the
Hmm.
new orders components is the one that has absolutely cratered. That's the one
Hmm.
that the conference board uses in their official leading economic index. And to me, the
Hmm.
reason it's so important is because it correlates extremely well with the S&P's return, which is
Hmm.
also a component of the conference board's LEI. And that's the advantage. If you can understand where leading indicators are going, you have a heads up on where equity returns are going, which sectors are likely to work, which factors will likely generate alpha. So I hate to narrow it down to one series, but that's probably the one that I think of is as the most helpful.
Hmm. Got it. Okay, so to close it out then, so I love the rules of thumb that you got embedded into practical macro, such as I kind of can go through the laundry list. I wrote a long list and I had to narrow it down. So GDP strong before the end of a tightening cycle. Yep, we recently saw that. 10-year yields tend to peak 6 months before the last hike. Not bad. Last hike was July 2023. The peak in yields was October 2023, so 3 months, not far off. Then another rule of thumb, there's often a relief rally just as the Fed starts cutting rates. Yep, we saw that. So which of your, so there are many of these rules of thumb in practical macro, which is what I love so much about it. So which rule of thumb do you think is most relevant right now?
Oh, that's a really good question, Rob. So the rules of thumb, there's always going to be variability, but they help you think about things at the right time. The one I think about the most right now, I don't think is a rule of thumb. It's more a bit of a jingle, but it's don't let the inflation genie out of the bottle.
Hmm.
And it comes from, I think it's Williams, one of the former Fed governors, looking back at the great inflation period of the 1970s. And that's the main conclusion that you'll find in any paper. But he's the one that coined that jingle. And
Hmm.
essentially, what it says is that once inflation starts to run, it's very difficult, to get back to price stability. And I think
Hmm.
that's the world, that we've entered in the post-pandemic era, if you will.
Hmm.
Tariffs are going to complicate this story somewhat.
Hmm.
But I think inflation is the main story right now when it comes to macro.
Hmm. So time for one final question. I mean, the genie did come out the bottle, didn't it, in what 2021, 2022 timeframe. So how did the Fed put that genie back in the bottle, or did they just get lucky?
Yeah. Well, it's a little bit of both. If you recall in 2021, the Fed kept viewing inflation as transitory.
Mm,
And so they did not raise rates initially. And they believed that it was just supply chain issues that
mm,
were, the problem that certainly played a role. But there were other inflationary forces at play, the main one being that we don't have enough workers in the US. There's more job openings than available workers. And
mhm,
so ultimately it's wage inflation that really became the problem. And wage inflation and core inflation are basically the same thing when it comes to data. So they raised rates, of course, dramatically,
mm,
trying to play catch up. I don't know if they really understood the underlying issue at the time. And so my big concern this year is that the Fed views tariffs as being also, a transitional effect on inflation and don't acknowledge that our economy is different, structurally speaking, meaning we have less available workers than we have job openings. That's
mhm,
a backdrop we haven't seen since the late 1960s, when
mhm,
inflation was also a problem at the time.
mhm,
So there's a lot of moving parts, obviously, but I think inflation going up this year is almost a given with all
mhm,
the implications that it has for financial markets.
mhm. Do you think that's what's driving gold?
Yes, inevitably. If the US economy is going to slow and inflation is going to rise simultaneously there's no better backdrop for hard assets like gold.
Got it. Cool. Well, we'll have to leave it there, Francois. For now, we'll come back to you.